Hi everyone, Nick here, welcome back. Municipal bonds have a lot of tax advantages and many people wonder if they should use them for part of their bond allocation. I've received many questions from some of you about this. In this video, we'll look at an overview of municipal bonds, risks, tax advantages, and then some things to think about if you're considering adding them to your bond allocation. First, we'll start with an overview of municipal bonds. These are typically issued by state or local governments, which means that they're generally secured by the taxing power of those state or local governments. There are also some other revenues that can be used to secure municipal bonds, such as toll roads, bridges, and so forth. There are also some federal subsidies that help subsidize municipal bonds. Now we get into tax advantages, which is one of the reasons why people consider municipal bonds. And it's one of the ways that the governments incentivize people to loan them money. This is because interest is usually exempt from federal and the issuing state's tax. Now, it might even also be exempt from some city taxes, for example, New York City. And the way this works, to be exempt from the state or city tax, you have to be investing in a municipal bond fund for your specific state. So for example, there might be a New York municipal bond fund containing all bonds issued by New York state governments or municipalities. And then that might be exempt from the state tax and even the New York City tax. This could make these bond funds a good deal for some people. There are some exceptions to the tax advantages. First, if you're retired using Social Security or Medicare, it will affect your modified adjusted gross income. It's not exempt from that, which means it could cause you to have to pay much more money in tax on your Social Security or higher premiums for Medicare. This might offset any potential tax advantages you would have. It also doesn't count for reducing your tax if you get hit with the alternative minimum tax. And there are some states' tax which don't exempt municipal bonds from the state tax. And some municipal bonds are just taxable in general. You'll have to double check for the specific municipal bonds you're buying or the bond fund and your state's tax code. Another thing is capital gains or losses are not exempt from taxes. It's just the interest you receive from these bonds. And the final point I want to make about the tax advantages is these only apply if you're investing in a taxable account. If you have these in a 401k or IRA or some other kind of tax advantaged account, the tax advantages of municipal bonds are basically irrelevant. This only affects you if you're holding a bond allocation in a taxable account. These tax advantages could mean higher returns for some people in some circumstances, but it is not without extra risk. So let's talk about some of the unique risks that municipal bonds have. First are liquidity. Bonds are less liquid, municipal bonds are less liquid, which could cause issues if you want to sell some before they mature. Another big risk with municipal bonds is almost all of them have what's known as call risk. And this is what's known as calling the bond. So many municipal bonds allow for the government to determine they want to repay the bond early before maturity. So if rates are going down, it might be advantageous for them to refinance those bonds at a lower rate. So they'll call the bonds, paying them off, and they'll issue new ones. This is similar to the risk with mortgage bonds when you have rates falling. Bonds with a call option will usually pay a little bit higher rate, but then you have this risk if rates go down that you might have to buy new bonds that have lower rates. The next risk is credit risk. People generally view municipal bonds as less risky than corporate bonds, but more risky than US government bonds. If you look at some data from Vanguard said the cumulative default rate on investment-grade municipal bonds was approximately 0.09% over 10-year periods on average, whereas global corporate bond default rates were 2.17%. This is according to Moody's data as of December 31st, 2021. One wonders how much of this could be related to the falling interest rate environment that was seen over the past 40 years and the past 10 years or more of near 0% interest rates. So it's unknown if default rates will change, if rates continue to rise, or if they'll stay near current levels. But it's probably likely that municipal bonds will be less risky than corporate bonds since they have some taxing and other authority that corporations might not have. For this reason, I think it's best to compare municipal bonds to US Treasuries. They're not apples to apples, but they do have comparable risk levels. But the US government has one big advantage. They can print money to pay you, whereas municipalities cannot. US Treasuries are extremely liquid and are generally not callable. For this reason, they are definitely less risky than municipal bonds, but they're the closest thing I think we have to compare against. You could try to look at a municipal bond fund and look at the credit rating distribution and find a comparable corporate or other bond fund with comparable credit ratings. But I think it's best to just keep it simple and compare against US Treasuries, and then think about if the risk trade-offs make sense for you. So in analyzing if this trade-off is worth it to you, I think one of the best places to start is the tax equivalent yield. And this just means estimating with the tax benefits of municipal bonds, how would that compare to a normal bond fund? And see what the extra return might be, and then if that extra return is worth the risk that you're taking, the extra risks. So in order to do that, I've put together this spreadsheet. And I'll put this in a link to this in the comments below, and you can modify these tax rates for your situation, and this might help you estimate. So to start, let's talk about the difference in taxes for these different types of bonds. So US Treasuries are not exempt from federal tax, but they're generally exempt from state and local taxes. Whereas municipal bonds are often exempt from federal tax. They're typically exempt from state taxes if they're municipal bonds issued within your state. And the same goes for city taxes. They are often exempt if issued in your state. Now, just note that you always need to double check this. I misspelled that, but you always need to double check this. There may be certain types of bonds or jurisdictions that have exceptions, but generally these will be true. So then when we go over into this table, I've got 5 different bond funds I put here for comparison. 2 are normal total market type bond funds, or just an international treasury index bond fund that you might typically put in a 3-fund portfolio. And then I've got 3 different municipal bond funds I've put here for comparison. So I put the expense ratio, the duration of those bond funds. It was difficult to find ones that have the exact same duration, and duration is another type of risk. The higher the duration, it comes with a little more risk. So when you're comparing these, you typically want to find ones that have a similar duration. So then you have the 30-day SEC yield, which is just listed on the bond fund's page or documents. And then in order to try to do tax-adjusted amounts, I've done it 2 different ways. One would be if you adjust to a pre-tax yield. So for example, in a US Treasury bond index, those are exempt from state and local taxes. So you discount that and you can adjust the rate up to account for that. Whereas with municipal bonds, you can adjust that for the federal tax in these total municipal bond indexes. Or in, say this person lived in California, you can also adjust up for the state tax in a CA, in a California municipal bond fund. Note the expense ratio for these funds. You get a lower expense ratio in the Admiral shares, which require $50,000 minimum investment. And then we have the adjusted after-tax yield. This is probably what matters the most. So this is just accounting for all the taxes and tax advantages. What is the apples to apples comparison of the final yield you'll get to keep after taxes? So when we look at this, we can see for this person, they have a pretty high federal income tax rate in this example. That would be 32% plus the net investment income tax, bringing it to 35.8%. And then maybe they have a 7% state tax rate for a total tax rate of 42.8%. You can see that after all the taxes are paid, in the more traditional total bond market or just an intermediate treasury index, they're getting about 2.55% to 2.66%, which isn't that great when you compare it to the municipal bond funds. You might be able to get a bit of an extra yield using municipal bonds if you're this investor. So that looks like it's about an extra 0.5%, maybe 0.6% compared to the total bond index. Some of these actually have lower duration, so you might be able to mitigate some of the duration risk with that as well. However, one thing to note is that even if you lived in California, which is unrealistic with this 7% tax rate, you might be closer to 10%. But even if you lived in California, oftentimes these state municipal bond funds start out with a lower yield because people are willing to accept the lower yield due to the tax advantages. And oftentimes what happens is any extra yield basically gets eaten away. So maybe if you're in the highest tax brackets federally and in the state, it might make a bit more sense. So another thing to think about is what is the break even for you? And I've just thrown in some random numbers here to calculate a break even rate where almost all these funds have the same yield. And that would be around a 24% federal tax rate and 6.8% state tax rate. I don't know how realistic that is, I just made that up, but you could try to figure out what your break even is. And in this case, it would probably not make any sense because you're taking extra risk with municipal bonds. So you'd want an extra return to compensate you for that risk. So real quick, I wanted to dig into one of these bond funds in a little more detail. So we'll look at this VTEAX Municipal Bond Fund from Vanguard, which is just the tax-exempt bond index fund Admiral shares. So it has a minimum investment of $3,000 to 3.42% SEC yield. So where it gets a little interesting is when you look more at the portfolio composition. These are medium duration and they are classified as treasury or agency. Although if you look at the credit ratings, it's actually not quite comparable to what you would typically see in this upper box, but it is better than investment in corporate grade. So I actually think it should be more like in the middle of these two boxes when you look at the style box. But yeah, that's something you can dig into a little more detail by looking at the credit rating distributions. So this is a pretty well diversified municipal bond index with nearly 7,600 different issues and a 5.8-year duration. And then when you look at the bonds in the fund, yeah, you can see they're basically all different municipal bonds. And some of them are backed by things like the Toll Authority of California or water and wastewater revenue, and so on. So this is a pretty well-diversified municipal bond fund, probably one of the best. These are the main considerations I think we need to make when we're determining if we should add municipal bonds to our bond allocation. The first and most important consideration is the tax equivalent yield. And for most people, the tax equivalent yield will not be a good deal. You really need to be someone in high tax brackets and someone who has a sizable bond allocation and a taxable account. For most people, this isn't going to be the case, so municipal bonds probably don't make that much sense. You can use a spreadsheet to estimate the tax equivalent yield. Just make sure to double check your state and local tax rates and how it would be affected by the bond fund in which you're investing. Oftentimes, you might be the case that the state municipal bond fund is no better after-tax yield than the national one. The national one will provide much better diversification. So when we think about a California resident in the 32% federal tax bracket, roughly 10% state tax bracket, and net investment income tax of 3.88%, they may get about an extra 0.5% in return and that's basically $500 for every $100,000 that they're investing in these municipal bonds in a taxable account. And then another scenario might be someone who's in the 37% federal income tax bracket, the 3.8% net investment income tax in a no-tax state, maybe Washington, Texas, or Florida. For this person, they might get about an extra 1% yield, which would be around $1,000 extra per year for every $100,000 they're investing. So these margins are fairly small, but it is a good amount of money if you're investing hundreds of thousands of dollars in bonds in a taxable account, which again isn't going to be most people. But even if it is you and you have a couple $100,000 you're investing in municipal bonds in a taxable account, you have to ask yourself, is it worth the extra risks to get that little bit of extra yield? Typically, we say there's no free lunch in investing. Sometimes there are big tax advantages, and this might be one of those cases where you can pocket an extra 1% in some situations. But there is certainly some extra risk. And what is the whole point of bonds in your portfolio? It is to be the low risk, like the ballast in your portfolio. And typically, the best risk-adjusted returns are from stocks. So that's a consideration you have to make, is it actually worth it to take the little bit of extra risk in the municipal bonds for that little bit of extra yield? Or should you just consider increasing your stock allocation a little bit instead, and just get the extra return there, which typically is a better risk-adjusted return than other means? So here's my opinion. I generally prefer to own bonds in a tax-advantaged account because they're less tax efficient than stocks. I also think that I prefer to take my extra risk with stocks since they've historically delivered better risk-adjusted returns. For these two reasons, I don't think I would ever add municipal bonds to my bond allocation. I actually don't hold bonds right now, but if I did, they would be in one of my tax-advantaged accounts. I looked it up and I think I would get about a 1% extra yield in my situation if I did hold bonds in a taxable account and I use municipal bonds instead of a normal bond index fund. However, I still don't think I would probably do this just because I prefer to get my extra risk from equities. And I just don't think it's worth adding the complexity to my portfolio. However, everybody's situation will be different. And it might be worth it to you to get that extra 0.5% or 1% return. Maybe you just want to do it with some of your bond allocation in the taxable account, or maybe you just want to keep it simple and stick with a 3-fund portfolio. Everybody's situation here will be different. Let me know what you think about adding municipal bonds to your bond allocation in the comments below. Thanks for watching, everyone. Later.